How might we test for goodwill impairment? Goodwill impairment testing is a process that companies use to evaluate whether the recorded value of goodwill on their financial statements is still accurate. Goodwill is an intangible asset that arises from a company's acquisition of another business. Testing for goodwill impairment involves comparing the book value of goodwill to its fair value. Here are the steps to test for goodwill impairment. Identify the reporting unit. The first step is determining the reporting unit for which goodwill is assigned. A reporting unit is a segment of the business monitored by management and for which financial information is regularly reviewed. Determine the fair value of the reporting unit. Determine the fair value of the reporting unit and compare it to its carrying value. The fair value of a reporting unit is the price that the unit would sell for in an arm's length transaction. Compare the fair value to the carrying value of the reporting unit. If the fair value of the reporting unit is less than its carrying value, the goodwill associated with the reporting unit is impaired. The difference between the fair value and the carrying value is the amount of the impairment. Calculate the goodwill impairment loss. If the carrying value of goodwill exceeds the fair value of the reporting unit, the company must record a goodwill impairment loss on its income statement. The impairment loss is equal to the difference between the carrying value of goodwill and the implied fair value of the goodwill. Document the impairment assessment. The company should document the impairment assessment, including the assumptions used in determining the fair value of the reporting unit and the amount of the goodwill impairment loss. It is important to note that goodwill impairment testing is not a one-time event. Companies must perform goodwill impairment testing at least annually or whenever there is a triggering event that may suggest that the value of goodwill may have changed. Examples of triggering events include changes in market conditions, changes in the business climate, and changes in the company's strategy. Here is an example. Let's say Riley Corporation acquired Coco Incorporated for $50 million, and as a result of the acquisition, Riley Corporation recorded $10 million in goodwill on its balance sheet. Riley Corporation has identified a reporting unit that includes the assets and liabilities of Coco Incorporated and other related assets and liabilities. To test for goodwill impairment, Riley Corporation must first determine the fair value of the reporting unit. Riley Corporation hires a professional appraiser to perform a valuation and determines that the fair value of the reporting unit is $40 million. Next, Riley Corporation compares the fair value of the reporting unit to its carrying value, which includes the book value of assets and liabilities, as well as the recorded goodwill of $10 million. The carrying value of the reporting unit is $50 million, $40 million in assets and liabilities plus $10 million in goodwill. Since the fair value of the reporting unit is less than its carrying value, Riley Corporation must perform a goodwill impairment test. Riley Corporation calculates the implied fair value of the goodwill by subtracting the fair value of the reporting unit from its carrying value. The implied fair value of the goodwill is $10 million, $50 million carrying value, $40 million fair value. Riley Corporation compares the implied fair value of the goodwill to its carrying value and determines that the goodwill is impaired. As a result, Riley Corporation records a goodwill impairment loss of $10 million on its income statement. Finally, Riley Corporation documents the impairment assessment, including the assumptions used in determining the fair value of the reporting unit and the amount of the goodwill impairment loss. Riley Corporation will need to repeat this process at least annually or whenever there is a triggering event that may suggest that the value of goodwill may have changed.